Hello, everyone. Happy Thursday. Basically, the Bears have been getting jumped. They've been getting beaten up by the Bulls. And today, the Bears, they had their back against the wall. Okay. They got into their defense and then they started to swing. Eventually, when you're swinging, land a punch. That was basically what ended up happening today. The Bears ended up landing a little punch. So, in today's video, it should be nice and quick because there isn't that much to talk about. We're going to take a look at the normal sectors, the SP500, the NASDAQ, the Russell, the dollar, the bonds, the VIX, the yields. Overall, this isn't the best bullish setup for the overall market, and I'm going to explain to you guys why. All right, so without further ado, let's get started with the video. All right, so now first, let's go ahead and take a look at. All right, so everything is pointed to a small pullback in the market. So this is a chart of the 10-year yield. And the yields are important because they have an inverse relationship to the market. If the yields are rising, then the overall market should be falling. Okay, so what do we see here? We see the yields very far overextended to the downside in terms of the Bollinger Band. What this is telling me is that we should have a small bounce in the yields. If we get a small bounce in the yields, then we should get a small move to the downside in the overall market. Nice, short and sweet, nice and simple, right? When we take a look at the bonds, right? The bonds have a correlated relationship to the market, right? If the bonds are rising, generally the NASDAQ and the overall market as a whole would also be rising. And you can see the bonds are very far overextended to the upside of the Bollinger Bands. When this is the case, we end up getting a pullback or a reversion to the mean. If we end up getting a reversion to the mean in the bonds and a bounce or a reversion to the mean in the yields, then the market should end up getting a pullback. And that is essentially what I'm looking at according to the yields in the bonds. This also holds true on the dollar. So the dollar is also very far overextended to the downside in terms of the Bollinger Band. You can see that it is clearly closing very far to the downside. And again, as a reversion to the mean, once we get a bit of a bounce on the dollar, because the dollar also has an inverse relationship to the market, if the dollar ends up bouncing, then that should be bearish for the overall market. So many different things are pointed to a small pullback to the market. And then last but not least, let's take a look at the VIX. So the VIX is bottoming out. So not only does the VIX increase as put buyers come into the market, the VIX and the volatility obviously increases as call buyers enter the market. So today, there was a lot of both. So that increased the volatility of the market, and that increased obviously the price of the VIX. So the VIX is generally an inverse relationship to the market. So if the VIX continues to rise, that is bearish for the market. And once again, the key levels that we need to watch on the VIX are what again? 13 and 1350. If we can break above those levels on the VIX, then that is going to be bearish for the overall market. But as long as we can remain below those levels, even 14, as long as we even remain below 14, this entire area, right? If we just remain here, then that is very bullish for the market. Okay. Overall, the VIX is also showing a bit of a potential for a continued move to the upside. The yields as well, the dollar, and the bonds. All right. So overall, all of these different indices, all of these different metrics are showing a potential pullback in the market. All right. So now, when looking at the SPY, right, this is obviously in general, this is a very, very bearish setup in general. But the fact that we got very, very positive news and a big push to the upside in both the SPY and the IWM, really, because of the interest rate news and because of the Fed, right? You don't want to fight the Fed. So the fact that this ended up happening is very bullish overall. If this did not occur because of news, this would be an amazing opportunity to short. But what I want to show you guys is an instance in history where we ended up just completely rising irrespective of technical analysis and how far we were overextended. we never got a decent pullback for a X period of time. So I want to show you guys that right now. All right, so the first instance is back here in April of 2021. You can see that we were very, very overextended. Obviously, we opened and closed outside of the Bollinger Bands twice. We gapped up above 400. Very, very overextended. All right. What ended up happening is we just continued to rise. We continued to make multiple legs up. And then going short here would have been profitable. Yeah, of course, you could have shorted over here and gotten it. So if you had gotten short on April 6th, right, it would have taken over a month for the price of the option to come back to that same price. So that is the issue currently. When this was based off of positive COVID, I believe. So when you get a strong move based off of positive macro news or positive some sort of global or economic, or like, of course, the Fed or someone, when you have positive news like this, we can just continue to rise. And then, of course, the risk increases like to go long as it continues to rise. That's why it makes more sense to get puts with a long period of time. And then as you continue to rise, you get a bit more aggressive to the short side. So this is one instance where this ended up occurring. So it's, you always have to keep an open mind, and you cannot always expect the market to do what you want it to. All right. So this was one instance. So then October of 2021 was another instance. Not as overextended to the upside in terms of the Bollinger Bands, but similar concept. We were very, very overextended. No chance of a pullback here. We never got a pullback. Even going short here, we never got a pullback to these levels. Nothing. Only until we made essentially the third leg up. That's when we got that pullback of retesting the initial breakout zone. So once again, if you were to go short over here on October 20th, this would have taken over a month and a half for the price to end up coming back to the original place where you would have shorted. So that's why, when you can't, it's tough to short against complete strength, right? So that is the only thing to be aware of. And as you continue to rise in the market, it becomes riskier and riskier to go long, obviously. But then it also pays to be more aggressive in your expiration date to your puts. So keep that in mind. These are two instances in history, essentially in the past few years, where the market ended up continuing to rise. And only once people became really, really bullish, once we did not get a pullback at all, this was a complete uptrend. We broke the uptrend. We ended up bouncing back and making another high. And then that's when we had the pullback. So just expect continued strength. It's tough to really be aggressively bearish. The only thing that you can do is, if you want to be bearish, you got to get it with time. And aside from that, this is basically, I just want to show you guys that on the SPY. This, we could just continue up. Obviously, now we take a look at the all-time high price, essentially at 480, right? If we can break above 480, the major psychological level, then we could, then the next major psychological level would be 490 and then 500. We could end up rising to both of those levels. And the thing that I want to show you guys is the percentage gain on both of these instances where we were very overextended, and essentially how much more room we had to the upside percentage wise. So say for example we went long over here, say for example we went short over here. Things were very overextended. This is a good little opportunity to short, right? Logically it makes sense to get a pullback, right? What was the percentage that we continued to increase? Almost 4%. Okay, almost 4% over here in April. Now when we go to October, let's see how much we increased in October. Say we wanted to go short over here October 20th. All right. How much percentage would we have increased? Almost 4.5%. Okay. So now 4.5%. Let's say today, right? We would have gone short. What is the percent? This is just to have some fun. All right. But what is the percentage of how much we would potentially increase had we gone short today? Make it 4.5%. That would put us right above 490. So that is going to be really interesting. And if we end up rising like that without getting a pullback, then that would be really, really, that'd be really crazy, to be honest. But you know, I'm excited. I'm very, very excited to see what ends up happening. I can't wait, to be honest. A lot of things will just need to be answered soon. And yeah, other than that, this is why the market is so beautiful. Like there's so many, it's just, there's a lot of different possibilities and things that can end up happening. And yeah, you know, to be honest, we're gonna have to see what ends up happening over the next few weeks. But yeah, so currently we got into 405 puts on the NASDAQ. We were pretty short overall on the market. And you know, it played out, it worked out. We dropped down to 400. You know, and yeah, we just need to see if 400 could break on the NASDAQ. If we can close within the Bollinger Band and we can get some sort of a major pullback. If not, then this has all of the reason to just continue to rise. The only thing is that tomorrow is OPEC. And after OPEC, we generally are sometimes bearish. So Monday, that would be interesting to see if we get a pullback on Monday and then what ends up happening. But yeah, you know, overall, the market is being held up by the IWM. And until the IWM gets a pullback and, you know, doesn't really have a reason to fall, to be honest. Doesn't really have that much of a reason to fall, because you have to think about this like in terms of what the market dynamic is for big money. They are now comfortable enough to realize that the Fed is going to be essentially, they're changing their policy to help prop the market up. So with the Fed helping essentially the market, right? They're not going to be increasing interest rates. They're not going to be hiking the interest rates. They're actually talking about decreasing them. So when that happens, that inevitably increases asset prices. So that's why it's important not to fight the Fed aggressively. Okay, so keep that in mind. There's potentially a lot of room to go to the upside, but in the short term, we're just gonna go ahead and trade this day to day in terms of day trading and all of that good stuff. And yeah, you know, let's see everything. Let's take it one step at a time. The dollar, the yields, and the bonds are pointing towards a bit of a bounce. And the VIX is also pointing towards a bit of a bounce, which translates into a pullback into the market. So let's see what ends up happening tomorrow. All right, so I hope you guys enjoyed today's video. Please make sure to like, comment, subscribe, do all that good stuff. I will see you guys bright and early tomorrow morning. Thank you.